Let's go to the second principle of investment. The earning of the maximum possible tax efficient income. A taxpayer is someone who doesn't have to take a civil service examination to work for the government. All of us are working for the government. You have this term which I always laugh when I hear it. All these people who are in government service call themselves government servants. One of the biggest lies throughout the world. They are not the government servants. We are the government servants. Okay? We are slogging, and a good deal of our money goes in the form of taxes. We are the genuine government servants, and we don't have to go through their UPSC, KPSC exams to get there. A.N. Shanbag, a very good writer on investment in India, he says, it is the duty of every income tax earner towards the nation to pay tax. It is also his duty towards his family to pay as little tax as possible. This very simple two sentences tells you what tax efficiency is. I pay my taxes. I always advise people to pay their taxes. If you can be a little tax efficient, instead of paying a higher tax, there is a legal way in which you can pay a lower tax. There is some facility given to you to you can get a tax exemption on something. If that is sensible, if that fits into your plan, you must exploit it. There is one more concept which is important, which people neglect. See, there are two activities. One is earning, one is saving. We earn what we have to spend, we spend, then we save. There is a limit to the tax that you can save on earning. There is section 80C, 1,50,000. There may be section 24 or your housing loan repayment as well as your interest to some extent. But beyond the point, you have to pay tax. So what should you do? When you're saving, you should see that the saving goes into avenues which are tax efficient. It is crazy to pay high taxes on my earnings and high taxes on my savings if I'm putting those savings into taxable avenues. This is one thing that we have to realize. I know I've said this many times, but probably it is the most important life lesson that I have learned. And let me give it to you again. There are things we can control, there are things we cannot control. Never worry about the things you cannot control. Focus on the things that you can control. I'm earning. Slowly, I cross the 2,50,000 basic exemption limit. It pinches me a little to pay tax. Okay, I do some tax saving, fine. Although I'm earning 3.5 lakhs with all the ATC, PPF and some other things, I'm not paying taxes, I'm happy. Now I cross beyond 5 lakhs. I'm the 20.6% tax bracket. Now what? 2,50,000 basic exemption, 1,50,000 section 80C, we come to 4 lakhs. Okay, I've got some housing loan. So there's some principal interest. Okay, I'm earning little more than 5 lakhs, but still I'm escaping the tax bracket or actually having to pay tax. Time comes when I get into the 30.9% bracket. Now whatever trick you try, you're still paying tax. So you can control only a very limited. When you put your money into a bank fixed deposit, my savings are all going into bank fixed deposits. Let's say 8% interest. The 8% interest is fully taxable. That I have to add it to my normal income and I have to pay tax on it. If I put it into real estate, real estate also appreciates in value, probably at a faster rate than the bank fixed deposit. Unless I sell, I don't have to pay tax. And when I sell, it will be long-term capital gains. And it will be at a lower rate. And there will be some probably exemptions. And there will be a concept called cost inflation indexing, where I can further lower the tax rate. There is much that I can control in the savings part of the operation. And one of the things that I can control is taxation. Or at least trying to be more tax efficient in my savings, because there's a limit to what I can do in my earnings. Taxation is something we cannot ignore, but it must be noted that tax is not more important than financial planning, investment, insurance, housing, etc. This is very important because world over, investment and insurance products are sold by touting their tax efficiency, thereby distracting potential buyers from their real objectives. There are some things that are very important. The insurance agent will keep on begging of you to buy life insurance. You will keep on putting him off. Finally, when February or March comes, he says, okay, you've got so much of tax to pay. At least buy this policy because it has got a tax exemption. So now he is converting an insurance product into a tax exempt product, which is wrong. Let me give you the other side of the argument. Today, one of the most commonly used tax saving tools by the middle class is the housing loan. Principal under section 80C, interest under section 24, that is if you have got only one house, or if you have got more than that, interest without limit, can be deducted from your taxable income. So if the property is reasonably expensive, quite a bit of tax saving there. My question is different. My question is the tax saving more important, or your house more important, or your real estate more important? Tomorrow, let us say with one stroke of the pen, the finance minister does away with all tax benefits attached to housing loans. Everything gets wiped out. Will people stop buying houses? Will people suddenly feel, okay, no, after no tax benefit, we don't need a house? They will continue buying houses. It is more important than the tax. It is like going to a shop to buy a cake of soap. When you buy the soap, the shopkeeper tells you there is some offer of a free soap tray with this soap, so he gives that to you also. I went to the shop to buy the soap, not the soap tray. I got it along with the soap, it's fine. But if I go to buy soap and come out of the shopkeeper confuses me and I come out with only a soap tray, then my whole objective has got screwed up. So the important thing here is the objective. If I need a house, I need a house, whether there is a tax benefit or not. But if I am taking a loan and there is a tax benefit attached to it, then it would be very foolish not to avail of the tax benefit. This is the meaning of handling or trying to view the investment and the taxation part of it. We should have total clarity on how we handle the two matters. Of course, the top thing is just in lighter vein. But moving to the bottom of that slide, there are two very simple measures that we can use to calculate tax efficiency. One is called the post-tax rate, the other is called the break-even rate. Let me explain both of them. Some people find it a little difficult to understand the break-even rate. You don't need to know both. If you know the simple post-tax rate, it is more than enough. And post-tax rate is exactly what those words say, post-tax, after tax. You know a businessman. Gross profit minus expenses, net profit. Same thing. I earn a rate of interest or income. I pay tax. Income minus tax, post-tax rate, net profit. It's as simple as that. The post-tax rate is the rate after tax payable has been deducted from the gross return. Let us take one simple example. Today, we are living in an era where the bank deposits are 7.5%. Let us say we have two choices. One is the 10% bank deposit. Let's say they are giving you 10%. The other is 8.1% PPF. These are our two choices. Now, supposing the bank deposit were tax-free. I am earning 10% tax-free. Total 100 out of 100 out of my 10%, cent percent as they say, is what I will get. So what you see is what you get because it is tax-free. Unfortunately, the bank deposit is not tax-free. It is fully taxable. And let us assume I am now in the 30.9% tax bracket. I don't get 100 out of 100. Out of this 100, 30.9 goes to the government, 69.1 comes to me. Therefore, my net return, my post-tax rate is only 6.91%. We started this example comparing 8.1% PPF with a 10% bank deposit. If I am not paying tax, my total income is only 2 lakhs per year. I am within the basic exemption. Definitely I must go for this. But if I am in the 30.9% bracket, please note that I do not own a 10% bank fixed deposit. I own a 6.91% bank deposit masquerading as a 10% bank deposit. This is a fundamental mistake that people make. This is actually upper KG level knowledge. But people make this mistake. We always, 10%, I've got 10%, very lucky. Yeah, you're 10%, you're not paying tax. Oh, no, I'm paying tax. What level? 30.9. Sorry, it's not a 10% deposit. It's a 6.91% deposit. We should always view things from the post-tax rate. This is called the coupon rate. You'll find this thing. The coupon rate is what I see on a coupon, what I see on a paper, what I see on a fixed deposit certificate, a fixed deposit receipt or government bond or whatever it is. This is not important. Post-tax is important. In something like the PPF, you have a situation like this. What you see is what you get. Why 8.1% you will get in at today's rates. It is totally tax-free. So regardless of which tax bracket I am getting 8.1. What I see is what I get. But when it is taxable, this is what I see, this is what I get. The two are different. The two are different. Every investment return that you get should be calculated after tax. 10% bank fixed deposit yields only 6.91% to the person in the 30.9% tax bracket. Now we'll take a few simple examples. This is nothing complicated, just examples. Look at the columns vertically. The first is the 5 tax slabs that we today have in India. The first is not a tax slab, it's more of an exemption. Up to 2,50,000 you don't pay any tax. Second is you pay 10.3% in this 2.5 to 5 lakhs. 5 to 10 lakhs you're in the 20.6% bracket. 10 lakhs to 1 crore of income, 30.9%. And anything above 1 crore, you are paying 35.54%. That is 30% plus a 15% surcharge gets you to 34.5 plus 3% cess gets you to 35.54%. Now, in this slide, I have taken, I think, 4 common taxable investments. All are taxable. This is the Government of India Savings Bond, Post Office Monthly Income Scheme, Company Fixed Deposit, Bank Fixed Deposit. Approximately what rates you can get today in the market, I have put there, approximate. Looks very nice here. Let's not go to persons earning above 1 crore, but let's go to people in the 30.9% bracket. This is what you see, this is what you get. Just look at these figures here. Look at these figures here. See the kind of damage done to them by only taxation. We have not yet come to inflation. And if we do our savings looking at these figures, when we are in this tax bracket, we are committing a very, very major mistake. So this is a situation where you have full taxability. Let's take one more slide. The 8.6% Senior Citizen Savings Scheme. Of course, not available to everybody, primarily to people above 60. But I have taken this as one more example of a taxable investment. It's taxable. The interest is taxable. So once again, looks pretty good here, but not very good here. Non-equity mutual funds, like debt mutual funds, you'll see a blank here because this is what we call tax efficiency. I'm coming to that separately. To explain to you what is tax efficiency there. Let's go to the 8.1% PPF, which is the exact opposite of this. This is fully taxable. This is fully tax-free. You can earn more than 1 crore. you can earn 1 lakh rupees, it doesn't matter. This is not affected by tax. See the damage here, see how the damage is escaped here. Then I've also taken equity, where today you have got a tax called the Securities Transactions Tax. It is so low as to be laughable. Therefore, it is largely tax-free. I've taken also a very conservative rate of say 12% return going forward. Once again, what you see is what you get in these two avenues. So in this one slide, we have an example of taxability, tax freedom. But if you see the objective of the second objective of personal investment planning, I have not said there that you should go for only tax-free investments. Why? In India today, we do have these two tax-free investments, virtually tax-free investments. The situation may not remain like this in the future. At some point of time, some future finance minister, some future government may decide to tax even the PPF or tax your equity long-term capital gains to some extent. What we have to see is, are there some tax-efficient investments where you are not paying at these rates, neither is it tax-free, but somewhere in between where you pay a tax but much lower than normal. And this is tax efficiency, and if we get a good tax-free investment, please take it. But at the back of your mind, you must know that for the future, possibly the world is moving more and more towards a certain amount of tax efficiency as opposed to total tax freedom. Let's get into a debt mutual fund, or I'll put it this way, a non-equity mutual fund. The definition of equity mutual fund in India is if 65% of the corpus of that fund is in stocks, it is considered an equity mutual fund. So we are now talking about something that's totally in government bonds, call money, short-term lending between institutions, treasury bonds, these kind of investments. I'll give you straight away an example. Let's say you make an investment in a debt mutual fund on 1st October 2011. You withdraw on the 1st of October 2014, 3 years later, it qualifies for long-term capital gains. And during this period, you are actually getting this rate of interest on these. I've taken a very realistic figure of 9%. The value of your 1 lakh investment, if you had invested 1 lakh on the first date, withdrawn it on the 3 years later, the value of your investment would be 1,29,503, not 127, because it is compounded. You are not withdrawing the money, it's accumulating. So the compounded annualized growth is CAGR, compounded annualized growth rate, would take you to about 1,29,503. Now this you are withdrawn. So when you are withdrawn, there is an income. The income is 29,503. But this is not interest income. Mutual funds are defined as securities. Therefore, this is long-term capital gains. You are allowed now, the definition of long-term capital gains is sale price minus cost of acquisition. So sale price minus cost of acquisition into 20.6%. That's the taxation. But the government allows you to increase this to compensate you for inflation. How does it help you? By publishing what are called cost inflation indexing figures, CII figures, every year. And how you calculate this is, you multiply this figure by the cost inflation indexing figure in the year you sold and divide it by the cost inflation indexing figure in the year you purchased. It's not so difficult to understand. The cost inflation figure for 11-12 was 785. The cost inflation indexing figure for 2014-15 when you sold it was 1024. Now, your 1 lakh you multiply into 1024, divide by 785, you get a figure of 1,30,446. What has happened? The long-term capital gain is sale price minus purchase price. Higher the purchase price in relation to the sale price, the less tax you pay because the capital gain decreases. You have understood this. So, the government gives you an official sanction to increase this purchase price. for the purpose of calculation of tax. It's a legal fiction. You now have your purchase price of 134,446, not 1 lakh. In reality, you have earned this 29,503. This is now to calculate and pay the tax. As we go ahead, what is the long-term capital gain? Long-term capital gain is 1,29,503. If the CII facility were not there, it would be 129,503 minus 1 lakh, which means 29,503. Because the cost inflation indexing figure is there, facility is there, 129,503 minus 134,446, you get, this is important, minus 943. So this legal fiction has converted your 29,503 into a notional loss. It's not a real loss. Really, you have gained 29,503. You now have a long-term capital loss of 943. Tax is 20.6% with indexation. But here there is long-term capital loss, no long-term capital gain. Therefore, there is no tax. This income that you have earned of 29,503 is totally tax-free. It is tax-free. The beauty of long-term capital losses, it can be carried forward in your income tax return for the next 8 financial years. During those 8 financial years, if you ever incur any long-term capital gain, you can set it off against the capital gain. Which means we are coming to a stunning conclusion here. Many of us think that the best investment that can ever happen to us is something that is tax-free. Here I can show you something that is better than tax-free. First of all, on what you have earned, you have not paid a rupee. Second, because of the legal fiction, you are carrying forward 943 rupees. You incur a capital gain on something else in the next 8 years, you can set it off and reduce your tax further. Isn't it better than tax freedom? So this is an example of tax efficiency, but that has resulted in tax freedom. The post-tax rate is 9% because you have got 9%, there was no tax on it. But let me warn you, this happens only in cases of or in periods of high inflation. Tax efficient is not tax free. It is only that in times of high inflation, it can be tax free. In case of balanced funds or asset allocation funds, the situation can be different. Let's take the same 3 years and take an investment that has given you higher returns and then see whether it's tax free or not. Same example, 1st October 2011, you withdraw 3 years later, the return now is 12% per annum, which was the returns given in this period by any good balanced funds in India. Value of 1 lakh would be 1,40,493. This is not an equity fund, please note, it is taxable. Same figures of cost inflation indexing. And you come to the same because it's 1 lakh. So you can increase your purchase price by up to 1,30,000. But please note, this 1,30,000 is now not more than this, it is less than your sale price. So let's do the tax calculation. Long-term capital gain, 1,40,493 minus 1,30,446 is 10,047 of long-term capital gain, not the tax, long-term capital gain. What's the tax? 20.6% with indexation. So long-term capital gain is 20.6% of 10,047, which means the tax is 2,070 rupees, 2070. Now, we do the calculations. What was your income? Your income was 40,493. Supposing you had received bank fixed deposit income of 40,493 and you were in the 30.9% bracket. What would have been your tax? Some 12 or 13,000. Here, it is only 2,070. And if you do the effective rate, 12% is what you got on your investment. The tax rate was 5.11 when you divide this and express it as a percentage. So you are still getting 11.39%. Whereas if you had a bank deposit giving you 12% and you had 30.39%, you would have got something like 8 or 9%. So here is an investment which is not tax free. It is not tax free. You are in the 30.9% bracket. But on this particular investment, you are paid only 5.11%. This is the meaning of tax efficiency. This is the meaning of tax efficiency.